Uh, what happened to you on a Peloton machine?
So I was at 199 core rides. And I was like, oh, sweet. Next one will be 200. Let's see if I get mentioned. So I sign up for one on Sunday and I'm super excited. And I'm there live, the first live class I've done, I think, forever. And I get there and like 2 minutes in, she's like, oh, I just want to congratulate such and such person for like 2,500 rides or 2,500 classes. And I'm like, geez, 2,500 classes. Like I'm at 200. How do you even get there? Like you got to be doing it like twice a day. And then with like 10 minutes left, she's like, oh, down to like the 700 people. And then with like 5 minutes left, she's down to like the 400 people. And I'm like, uh-oh, time is ticking. I'm not sure she's going to get to 200, or maybe it's not even a milestone because there's so many people have much more than I do. And with like 30 seconds left, she spews through all the 200 people in a row. And my name gets called. First time ever. My name was called out loud in Peloton class.
Wow, dude, you made it. Let me hold on, wait. So, question, listener, what is Brett's name on Peloton? You don't know, Brett? Please share with the listener.
Why don't you tell us, Marcos? You do it too. You used to do it.
Well, yeah, but my name was M. Segrera.
Oh.
Boring.
I am B Dog 2000.
That's right.
Dog pound.
B
You know, when you found something that works in college, and at that point, getting 2000 was difficult because everybody wanted the number 2000. Suddenly now nobody wants a 2000 anymore, so it's easy to use it as your username.
All right, B Dog 2000.
Welcome to another episode of Talk Your Chart, number 24. Brett Horowitz here with the talented Marcos Segrera. And I think because in the past, we've constantly sort of overruled our one rule, which was one chart per episode. I think today we do it rapid style, lots of charts in one episode.
Let's see how it goes, and the listener will give us feedback.
There's a lot to talk about. Last month was horrible, so we're going to start with a blended portfolio, 60 stocks, 40 bonds. And this is going back, 80, almost 80 years.
Wow, this is only U.S. stocks, right?
U.S. stocks, 10-year bonds, treasuries, so you're not talking about any credit risk in there. But you can see here, so far year to date, as a couple days ago, the worst return since 1931. Ouch.
Yeah, that's painful. That's obviously, stocks are down, but what usually happens to bonds when stocks are down? Not what's happening this year.
Right. And you look back, I mean, it has been a fantastic ride going back to 2008, right? You had only one negative time in 2018. The rest have all been positive.
It's a blip, a 2.5 down. Yeah, diversification from a stock bond standpoint hasn't been what it is. But here's the thing, it's not surprising. Basically, the worst environment that a bond has to live through is what we're living through right now. So then the silver lining is forgetting what's happened, because it's already happened. Hopefully you haven't made bad decisions leading up to this. Looking forward, bond returns haven't looked this good in years.
Well, you talked about diversification. I mean, this next chart shows you it's not just bonds that are doing poorly. You're talking about U.S. stocks, foreign stocks, large value, growth, oil, gold, commodities. I mean, it's just brutal everywhere around.
Where's crypto on this chart? Where's Bitcoin?
That would be negative as well.
Yeah, look at that. Cash is king.
In this case. So I think you've had the expression before, diversification works over time, not all the time. And so that's what we're seeing here. Yeah,
diversification means always having to say you're sorry. And in this case, stuff's getting banged up. So that's also crazy. If you look at, where is it? Long bonds down 30%. Hello. Yeah, not good. Worst bond market since the 1800s. Not excellent.
Well, yeah, in this third chart we're showing here, here's a combination of the 20-year bond and the S&P 500. So you're talking about not as long as a 30-year bond, but 20-year bonds. And so most cases, you've had periods of time like this where S&P has been down. You've had periods of time where the Treasury's been down, but both being down as much as they are this year. I mean, it's far worse than we've seen in almost every other period of time.
Yeah, and the chart makes sense to me because I'm looking at 70s and 80s, and that's when you get that kind of that same negative experience at the same time. But the magnitude of this year is obviously an absolute outlier. It makes sense because of what the Fed has done to interest rates. When you get a 2-year treasury up 1,500% in 12 months, things are going to break, right?
Yeah, you're going to show us a chart about the scaling up of the interest rates.
Oh, is it my turn? Can we look at that?
Go for it.
So look at this thing. Pardon the people in the bottom right corner, a little podcast I listen to called the All In Podcast. Jason Calacanis, Chamath Palihapitiya, a self-proclaimed next Warren Buffett. Okay.
Said that very well.
So this is interesting. Why? Because it's showing us different Fed hiking cycles from 1983 to the current one. It's showing us the number of months in the hiking cycle, and then concurrently how long it took for the S&P to bottom. And forgetting all the specific numbers there, the big signal for me here, BH, is the bottom comes before the cycle is done. So what this leads me down a path of thinking is, once the market sees the end, basically how I would put it is, once the market sees that we're closer to the end of the hiking cycle than to the beginning, we're going to start forming a bottom. When that is, how the magnitude of that, I have no idea, but you're not going to see it coming because the markets always call it 6 to 10 months ahead of this stuff.
Well, what speaks to me, this chart is, it's like climbing Mount Everest that we're going through right now. You look at all these other things, and if you were a runner or you're a biker, you'd say, okay, it's got some hills to it. But the speed at which these interest rates have gone up, as fast as it is, I mean, you look in 2015, you're talking about over 3 years for it to get from point A to point B. Here we're talking about what, 5-6 months? It's incredible, the speed.
Yeah, I know. And that's everyone's playing Monday morning quarterback and having a go at the Fed because it looks like they absolutely blew it. They were easy for too long, and now they're absolutely slamming on the brakes, perhaps unnecessarily. The soft landing that they're trying to engineer, it seems basically impossible to do, but maybe because how wacky the labor market is because of all the COVID stuff, we get some wacky outcome, which in my opinion, the wacky outcome would be a soft landing, right?
But yeah, you and I talked about before the episode, it almost like Jerome Powell is rooting against me in my bet to say that a recession will not happen last year, because he's basically saying it has to happen next year. And unless there's another way to get inflation down, which no one really sees how that's possible, it almost has to happen, and he's forcing it to happen.
There's demand destruction. It's happening. The hard data just doesn't show it yet. So we'll see when it starts showing up. But I will tell you, once you get the biggest money printing companies a la Apple and Meta and all these places saying that they're going on a hiring freeze and going to shrink a percentage of their workforce, that's the beginning of this stuff, right? Because they're not doing it because they don't have the cash, right? They have plenty of cash to do whatever the heck they want with. They're making a decision that says to keep a certain level of profitability, we have to do this. So that once that starts showing up in the hard data, I think Jerome Mini Volcker gets what he wants, which is the pain. But also in his shoes, he's in this tough position because we also talked about this. If he comes out and gives any inkling of dovishness, we get July again. Markets snap back and then it's all undone. So it's a tightrope.
So you talked about Meta, and one of the charts that we shared with our viewers a couple episodes ago was the top 10 stocks by decade. Meta was in the top 10 2 years ago. I think it was 2020. And the chart I'm showing here is Meta's performance over the last 10 years and just the sheer magnitude of the drops that's gone on, where now they're talking about, they call it a death spiral. You know, the company is just hemorrhaging customers. Not everyone's using it. The young people are going to TikTok and Instagram. Meta's down 60% just about year to date. And if you do the math on a 60% drop, they would need to return 125% to get back to where they were.
Yeah, not excellent. They're still in the top 10. Who knows what'll happen?
Well, but you also made the I think the explanation before that just because a stock doesn't go to zero doesn't mean it's a bad stock or good stock, right? This stock is still a big stock. A lot of people have shares and have accounts at Facebook, but this stock being down 60%, it hasn't gone out of business, but that's a brutal hit to this company, as well as a lot of other ones as well.
Yeah, I think this is like a classic just divergence of stock price and business outcomes, right? Yeah, the business is definitely struggling and they're pivoting, But if you're leading Facebook, obviously you have to live quarter to quarter because you're a publicly traded company. But at the same time, they're thinking decades into the future. So all this positioning at some point, if they execute properly, the business fundamentals and the stock fundamentals will eventually converge at some point in time. But that's not over the short term. That's not how that stuff works. So yeah, good luck recovering from 60%. But if you liked it at beginning of the year, you must love it now.
Well, they're like a lot of technology companies, they're firing a lot of employees. When we talk about jobs, that's where a lot of the jobs are coming from, the job openings.
Yeah, and that's what we want to see. I have a jobs chart, but you want to do your, what's this next one that you have?
Nope, go ahead.
Okay, stick with jobs.
Yeah.
So this next chart I have, it's the JOLTS report, which it's funny. I don't think anyone knew what the JOLTS was until now, when everyone's trying to see what employment is doing. JOLTS just stands for job openings and labor turnover. The S is whatever you want to say it stands for. What this chart is showing us is that the soft data that isn't reflected in hard data, like the employment number, right? So the employment figure is the hard data, right? What's the level of unemployment in the US? The soft data is all the things that go in there to help drive that number. At a certain point, soft data and hard data can't be totally different. They're divergent right now. So ultimately, if you let's look at the bottom part of this chart, BH. This is a ratio of job openings per available worker. Everyone's been quoting the stat of there's 2 open jobs for every worker. Well, although it's still not down, as you can see, there's also just been, since March of 2020, this massive ramp up, right? And what's come down, we're not necessarily saying that, and I don't think the Fed's saying that needs to go back to what it was in December of 2019. I think what they need to see is just a trend in the other direction, which it looks like we're starting to get that. So if you go from 2 to 1.85, that's a good trend.
Yeah, they call it green shoots, right? You're looking for tiny little positives that you can get out of the market to say the worst is over. Whether that's jobs, whether that's, we're going to show in a few charts, manufacturing, whether that's in the chart I'm showing here, inflation, and, talking about core inflation and headline inflation. And yeah, it's come down a little bit. And so every time that the Fed announces a slightly weaker number, the markets cheer because they say, okay, worse is behind us. But every time they announce a slightly stronger number, it's okay, this is going to last a lot longer than we think, and they're not in control of it, and they're going to keep rising rates. So at this point, it's a battle between optimists and pessimists about what's going to happen for the forward few months.
I agree. It looks like we peaked in June, right? It looked like CPI and PCE peaked in June. So we just need that to come down more and more.
Yeah, but it's not going to come down a straight path, as neither is jobs. Jobs are not going to come down month after month after month. It's just going to be a little bit of bumpiness, but you just need to see that trend come down.
Yeah, the market has to look through it at some point, and then we'll start getting, again, forming that bottom. I just don't know how Powell and those dudes and gals at the Federal Reserve start positioning. I think they get through I think their next 3 hikes through 22, get us to 4.5 on the Fed funds rate, and then perhaps say we're taking a break. Fingers crossed.
Well, it's unfortunate that we have to now be rooting for either less good news or bad news, right? This Friday, we come out with the jobs report, unemployment report, or jobs report for the month of September. And everyone wants it to be a weak number. And now we're going to be cheering when it's weak numbers, because that means the Fed's going to stop raising rates.
It's true. Here, look, so the needle that they're trying to thread is the fact that a lot of the job openings are poaching people. So once job openings come down, you're hopefully not going to get a ton of firing necessarily. And then also, you could get the denominator, meaning the number of people working in the calculation for unemployment. If that goes up, unemployment also goes up. So the people that are on their butts, perhaps living off, again, parents, right? People that were unretired, retired, and not come back into the workforce. If that denominator gets bigger, unemployment still goes up without having to fire anybody. And I think that's the last straw of hope that the Fed is hoping for to somehow do this whole soft landing.
I don't see people going back to the workforce who have either retired or are scared of COVID or still have issues.
Wait a second. You set this up perfect. Let's go to your next chart. And this is why people are going to go back to working.
Which chart are you talking about?
Mortgage rates.
What about the unemployment chart? No, we're not going to that one.
Yeah, I'm in, but let's do your mortgage one because it's perfect.
Yeah, I mean, you're seeing this incredible rise from 3% to start the year to, I think it's now even over 7%.
It is.
And that's if you've got a good rate. Now, these are fixed rates, so you can get a little bit lower if you go variable. And I know that a lot of people now are thinking maybe I'll put in a variable rate because in a year or two, maybe rates are lower. And so I can start off now and refinance in a year or two. But
anyone with an adjustable rate mortgage is going to, two things. Number one, demand destruction. Now, an additional $500, $1,000 of your spending per month is going to go to service your debt. So if you weren't productively employed, you better be soon, right? So you better get back into the workforce. If you have an adjustable rate mortgage, and I don't know what the stat is in the US, I haven't found it. In the UK, 40% of home mortgages are ARMs, adjustable rate mortgages. That is a bananas number to me. I couldn't believe it was so high.
Well, if I had to get a new mortgage today, I might consider adjustable rate. But you're right. These numbers, the one thing the Fed is doing is having a huge impact on the housing market, which impacts how much you spend when you go out and try to fix your house, which changes how much you can rent your house for. I mean, in that case, in this point here with housing, it is being cooled off. They're not having much success with unemployment. They're not having much success with people spending money. But at least in this case, they're hitting it hard.
Yeah, housing could be what breaks first, right? And that's the US economy is so tied to housing, because if you have a housing unaffordability index that's the highest it's ever been, you have to get one of three things to happen. Either prices come down, rates come down, or both. So it'll probably be prices first and rates later. All right, let's look at my chart that is market inflection points with recessions. This is me just going back to saying the recovery is going to start before the news gets better. So what we're looking at here, let's look at the color coordination. The purple line is unemployment. The green line is the S&P. The black bar cutting across the two purple and greens is the market bottom. And what you can see across time periods, right? These are all covering different periods of time. The market bottoms, and many times unemployment continues rising before eventually leveling off and coming down. So why do we show this? Just to remind everyone, the market's forward looking and it's going to find and form a bottom before you think it should.
Right. You can't wait for things to get all rosy and see unemployment come down for 6 straight months and then say, okay, now I'm going to get back in because now everything is looking good going forward. At that point, you've missed a lot of the rally already.
Of course. And the consolidation happens. These things, I think they're moving quicker and quicker, in my opinion. We'll see what the recovery is like without a Federal Reserve, even though you can put me in the camp that when the system starts breaking, the Federal Reserve is going to intervene.
So, yeah, I mean, I think you're right. Everyone expects that when things get so bad, the Fed's going to pivot and change what they're doing. They're predicting out so far in advance, but you've got a great chart showing how great that prediction is in terms of what they did in the past.
Let's look at it right now. So this, and again, this is like a confusing thing to look at. And could they have named this chart any longer? What a sweet name. The highlighted portion is what's important. It's the federal funds rate that they, in June 2021, said that the federal funds rate would be 0.6% in June 2022. And right now, what are we looking at? A Fed fund rate that's currently about 3.25. So in June 21, they said the Fed funds rate in 22 would be 0.6. And I made the joke earlier, you know how many PhDs were in the room when they made that prediction? So we can, again, not to be pointing and saying, what idiots, oh my gosh, it's easy to do when it's not your job to do these things. What this means to me, the signal here is they can pivot quickly.
Yeah.
And so once the data is there, and maybe not as much data as you think, but enough for them or vice versa, right? It's never going to be perfect. But once the data is there, they're going to pivot. And we can see something like this.
They have said they're data dependent. And so for you to expect that rates will be where they think rates will be, I wouldn't put my money on that, because we've seen that a few months, and we had yesterday an ISM, which is manufacturing survey, that was just slightly over 50. Anything over 50 is expansionary. Anything under 50 is contracting.
Yeah.
It's barely above 50, hasn't been there in a while. And so these are positive signs. So as you see the economy weaken, as you see these things come down, the Fed is going to move on a dime because they don't want to move too quickly, because that was the mistake they made a few years ago, or in the 80s, I should say, when the Fed started to reduce rates too quickly and then inflation spiked again. But they're not going to wait for things to just get into a depression level before they start changing their mind.
Yeah, and we'll see if they cut. If they can somehow get it to last, they'll just leave the race as is, and we'll see how much breaking happens.
But cutting isn't even have to happen, just stopping. I mean, that's a huge relief right there.
Oh, yeah, of course. Once you know what your kind of that marginal rate's going to look like and be, even if it's higher for longer, that's going to be a relief for the market. And again, it'll see through that.
Okay.
BH, what are the charts? That's it? That wasn't enough charts for me. I want more.
We'll give the people more in a few weeks.
I know, we will. All right, my friend. Hopefully no recession in 23, but it's still my base case.
The Fed's doing everything to make it happen, which is not good for me.
I send Jerome a text. I'm sorry.
Thanks. Talk to you later.